Right, we are now going to look at two different types of income statements that you could prepare for a merchandising financial statement. So again, merchandisers, this is when we are selling goods. So we've got our sales revenue and our cost of goods sold. So the first one that we'll look at is the single step income statement. Now a single step statement groups all revenue accounts together and all expense accounts together. And you take your total revenue, subtract your total expenses to get down to net income. So these are not broken out depending on what type of revenue or what type of expense. Instead, you just lump all revenues and lump all expenses. So this is a bit easier to do, but it doesn't give the same amount of information as the multi-step that we'll see. So that's single step. The better and more informative statement is now a multi-step income statement. So you can see here the various steps that occur. We have just our sales revenue and the contra accounts to start. So the main business of a merchandiser is selling inventory. So we break out these main parts first. So we have our sales revenue. We subtract these contra accounts, so our discounts and our returns and allowances, which gets us to our net sales. From there, we break out just the cost of the goods sold, and then we subtract this. So we take our net sales revenue minus cost of goods sold, which gets us to our gross margin. So we talked about that earlier in this chapter. It's the amount that we have left to pay off the rest of our expenses. So your gross margin is what you make just from selling goods. The selling price is higher than the cost of those goods, so you make this gross margin value. Next, below that, we subtract our operating expenses. I'm just trying to look. So they've done this a little bit weird. So this amount adds to your operating expenses. You would typically actually see this 201 below down here after you've got to the total. So we're going to just change it up. I like this a little better. So our operating expenses, they're not direct expenses needed for these goods sold. So we move them below the gross margin, but they are still normal expenses as part of running this merchandising business where we sell goods. So they are normal expenses or expenses in the normal course of business. And these are often broken out into selling expenses and general expenses. So any expenses that we have that's directly related to selling. So maybe advertising, that would be part of selling because we have to advertise in order to get sales made. Things like that would go under the selling expenses. And then general expenses would just be, in general, what do you need to run your business? So office expenses, office supplies that's used, office salaries for those staff, things like that. So they're not directly related to selling goods, but they're still needed in the normal course of running this business. So once we take our gross margin, we subtract these operating expenses, we get down to what's called income from operations. So this is what the normal income or the income from running the normal portion of the business is. So this is likely to continue year over year. From that, we either add or subtract our other revenue and expenses. So other revenue and expenses are items that are not part of the normal course of business. So not that they happen by coincidence, but they're just outside of what we would normally do in this business. And therefore, they might not recur year over year. And because of that, we want to keep these separate so that a user looking at this statement knows, oh, these are just other items. Can't necessarily expect them next year. Whereas our income from operations, since that's part of our normal business, we would expect to have similar levels of these amounts year over year. So we take our income from operations. Here we had more expenses in other than we did revenues, so we're subtracting that, and we end up getting to net income. So you can see here, if we compare these to the single step versus the multi-step, we get down to the same net income under both because we're adding the same revenues, subtracting the same expenses. But by doing this multi-step, we're giving a whole lot more information. So we're pulling out this gross margin so we can look at that and see how well the company's doing just from selling items. We also can see here the income from operations. So what is the company expected to see in these normal business year over year? This income from operations is predictive of what will happen in the future. And then it just shows what's kind of other that may not happen. So multi-step, definitely more informative and therefore used more often because the users want this extra information. Okay, so these slides just go through what I've already discussed on the last slide. So take a read of them on your own. They give you some extra examples of selling and general expenses, as well as a little bit more information and some examples of other revenues and expenses. Okay, the next thing that we see in Chapter 5 is some ratios. Now, I think that we've got just a little bit more time once we get to Chapter 6. So I'm going to save these and we'll go through in Chapter 6. So we're going to cover them. If you've already read them in Chapter 5, that's great, but I'll have the video when I post Chapter 6 just to even the time out a little bit.